Annuities, what are they? Okay, so annuities are a financial plan characterized by regular payments. So that regular payment is very important for defining what an annuity is. So generally these are going to have a fixed schedule. They start getting a lot more complicated if they don't. So generally has a fixed schedule of payment. And so what that means is yearly, monthly, quarterly, etc. Could have weekly, could have decennially, quadrennially, etc. But usually the typical ones you're going to see are yearly, monthly, or quarterly payments, possibly semi-annually also. These are, the main example for this is car loan. Okay? Mortgage. Or student loan. And so the idea here is that you have borrowed a large chunk of money, or you're borrowing a large chunk of money, and then you pay it back with regular payments. And so the annuity describes the financial vehicle used to do this. Some other examples are retirement plan. So that can either be contributions or the withdrawals. And so by retirement plan, we're talking about 401ks, IRAs, all that good stuff, right? Individual retirement account. There's some other ones too, but they generally work the same. The idea is that, you work for a while, make regular payments, and you want it to accrue to a large amount, which then you have to spend in retirement. And once you have that large amount to spend and you're retired, you start making withdrawals. There's some other things that work this way. So hold on. Some other things that work this way. So corporate bonds, you could think of as annuity, treasury, some other vehicles like that. But these usually have a fixed payment on the principal. These have compounding interest, and so that's different. These are the ones we're going to mainly focus on. But this is also, you could think of this as a different type of annuity. And typically, there's compounding interest. And so that's important. This compounding interest is either on payments or the lump sum owed. And because we're again talking about the typical ones, that's what we mean. So these are the ones that usually have compounding interest on the internal workings of it. A couple other things you want to be aware of is future. So this, and if you want the lump sum in the future, then you're looking for the future value. And if you want the lump sum now, then that's present value. So you're going to be looking for present value. You can think of the lump sum means large amount. And so with the car loan or the mortgage or the student loan, it's typically the present value because you're borrowing it now and then you have to repay it. With the retirement plan, when you're making contributions, that's future value because you're going to have that when you retire.